We are tackling a story today that, I don't know, it feels a bit like the third act of a suspense movie.
Oh, yeah. How so?
You know that scene? The hero cuts the red wire, the timer stops, everyone breathes this huge sigh of relief. But then the camera pans down, and you see a second silent timer ticking away under the table.
That is a very vivid, if slightly stressful image to start us off with.
Well, it fits the data we've got in front of us. We're looking at the precious metals market, specifically the fallout from that massive Section 232 executive order news this week.
Right.
And if you were just scanning the headlines, watching the tickers, you probably saw a lot of green flags for silver. The whole narrative was crisis averted. The U.S. government decided, at least for now, not to slap immediate tariffs on critical minerals.
It definitely looked like a victory lap for the silver bulls. I mean, the immediate threat of a trade war tax, which would have just complicated everything, was paused. The market let out a collective breath.
Exactly. But that's where our second timer comes in. We have a fresh, deep dive report here from JP Morgan, and they're looking at that same celebration and basically saying, hold on, not so fast. They're spotting a massive divergence. While the headlines are cheering this pause, the underlying data suggests silver might actually be walking into a trap, while gold, which often gets lumped in with silver, is gearing up for something, well, historically significant.
It really is a tale of two metals. What JP Morgan is highlighting is that the headline news, this tariff pause, is essentially masking some deep structural cracks in the silver market.
Okay.
And at the same time, gold is operating on a completely different set of drivers that have almost nothing to do with industrial supply chains or, trade tariffs.
Right. So that's our mission today. We need to figure out why these two metals, which usually move together as precious metals, are suddenly speaking completely different languages. We're going to look at what JP Morgan calls the mirage of the recent silver rally, a huge technology switch in solar that could genuinely crush demand, and why central banks are buying gold like there's no tomorrow.
And we absolutely have to talk about that 180-day negotiation window.
Yeah.
Because that is the clock that is still ticking away.
Right. Let's start with that hook. Section 232 order comes out. No immediate tariffs on silver. So why shouldn't silver investors just pop the champagne? I mean, avoiding a tax is usually good business.
It is good news for liquidity. Absolutely. The fear was that a tariff would, essentially build a wall around the U.S. market. It'd be incredibly expensive to import metal.
Sure.
Since that didn't happen right away, the pressure eased. But the report makes a crucial distinction. This isn't a pardon. It's a strategy of negotiation over taxation.
Negotiation over taxation. That sounds like diplomatic speak for a shakedown.
It's leverage. The order opens a 180-day window for talks. The U.S. is basically signaling to its trading partners, look, we won't tax you today, but we need to adjust how these trade flows work. It's a sort of Damocles hanging over the market.
So it's not freedom, it's probation.
Exactly. The market isn't free, it's just on hold.
Okay, so silver is on probation. But if I look at the price chart, silver doesn't look like it's worried. I mean, since Christmas, the price is up roughly 25%. That looks like a bull market to me. Why is JP Morgan using words like mirage for a 25% gain?
This is where we have to look under the hood.
Uh-huh.
It's what analysts call a price-volume divergence, and frankly, it's unnerving when you see it this starkly.
Okay.
Yes, the price is up 25%, but usually when a price rallies that hard, it's because new money is flooding in. Investors are buying ETFs, they're increasing their positions, they're chasing that momentum.
Right, buying the hype.
Yeah.
FOMO.
Exactly. But the data shows the opposite is happening. During that same period, while the price was skyrocketing, silver ETFs, and these are the big institutional vehicles that hold physical metal, they actually saw a net outflow.
An outflow.
We're talking about 18 million ounces of silver leaving ETFs.
Hang on, let me make sure I've got this right. The price is going up, but the big funds are selling 18 million ounces.
Correct. They are bleeding assets. Investors are using this higher price as an exit door, not an entrance. They're selling into the strength.
Wow.
And it's not just the ETFs. If you look at the COMEX management money.
Okay, just for the listener who isn't refreshing their Bloomberg terminal every 5 minutes, when we say COMEX management money, we're talking about the futures market, right? The smart money.
Exactly. These are the hedge funds, the large speculators.
Right.
Their net long positions, basically their bets that the price will go up, have been shrinking since mid-December.
So the price is rising, but the people who supposedly know the most are betting less and less on it.
It's like a restaurant raising its menu prices, while the customers are quietly walking out the back door. It suggests the rally is fragile. It's not supported by the fundamentals. It's kind of floating on thin air.
And I'm guessing that when you combine that shaky financial picture with the actual industrial picture, things get even worse.
That's where it gets really rocky.
Let's pivot to that, because this is the big differentiator between them, right? Gold sits in a vault and looks pretty. Silver has a day job. It has to go to work in electronics and solar panels.
It's a critical industrial metal. And for the last few years, the narrative has been all about the green energy transition. Solar panels need silver for conductivity. It's the best conductor of electricity we have.
Yeah, we've always heard that the solar boom is the golden ticket, or I guess the silver ticket for demand. More solar panels means more silver needed. Simple math. So why is that a problem now?
Because markets have breaking points. The price of silver has gotten so high recently that it is starting to cannibalize its own demand. The JP Morgan report highlights a statistic that, honestly, it stopped me in my tracks. Raw silver material now makes up about 30% of the total selling price of a solar panel.
30% of the final cost is just the silver paste.
Yes. Think about that from a manufacturing perspective. Margins in solar are razor thin to begin with. You can't have a single raw material dictating a third of your final product's price. It's economically unsustainable.
So what do?
Engineers do what they always do when a material gets too expensive.
They find a cheaper one.
They innovate around it.
Yeah.
Solar manufacturers have been experimenting with copper substitution, replacing that expensive silver paste with copper for years.
I've heard about that, but I thought it was tricky.
It is. Copper oxidizes, it's harder to work with. So as long as silver was reasonably priced, say $20-25 an ounce, it wasn't worth the hassle of retooling entire factories.
But now that silver has been rallying...
Now it's an emergency. It's no longer just an R&D project, it's a survival strategy. The report indicates that leading photovoltaic companies are accelerating their plans drastically. They're expected to start implementing copper substitution technologies starting in the second quarter of this year.
Q2.
Right.
That's right now. That isn't some 5-year plan.
It is imminent. And the scale of the demand destruction here is significant. JP Morgan estimates this switch threatens demand for roughly 50 to 60 million ounces of silver annually in the coming years.
That is just a brutal irony. Silver's price success is effectively killing its future job security. It literally priced itself out of the market.
It's the classic industrial reality check. And that explains why the institutional view is so cautious. You have investors leaving the ETFs, and you have industry leaving the physical metal, both because the price is too high.
And meanwhile, while all this is happening, there's this weird game of musical chairs with the actual physical supply. The inventory, we touched on the tariff scare. How did that physically move the metal around?
This is fascinating. We can call it the Great Inventory Migration of late 2025. Before the executive order came out, the rumor mill was just churning. Everyone was terrified that the U.S. borders were about to close to foreign metals.
Right, so if I'm a foreign bank holding silver in a New York vault, I'm worried I might not be able to get it out.
Or that if you needed to sell it to someone in Asia or Europe, you'd be stuck paying a massive tariff to export it. So people panicked. They started shipping metal out of the U.S. en masse. Inventory was fleeing from the COMEX vaults in New York and heading to the LBMA vaults in London.
Why London specifically?
The London Bullion Market Association, the LBMA, is the main hub for global spot trading. It's considered neutral ground compared to a potentially tariff-heavy U.S. If your metal is in London, you can sell it to anyone in the world.
Okay, so how much metal actually moved during this panic?
The scale is massive. COMEX inventory in New York dropped about 100 million ounces from its peak back in October. In January alone, right before the order, the outflows accelerated to an average of about 2 million ounces per day.
2 million ounces a day leaving New York. That sounds like a run on the bank.
It was a defensive evacuation. But here's the nuance, and this is what JP Morgan spotted that a lot of people missed. Even with all that metal leaving, the inventory levels in New York are still roughly 125 million ounces higher than they were before the 2024 election.
Wait, so despite the panic selling and shipping everything to London, we still have a glut of silver sitting in New York?
Exactly. There's a structural oversupply sitting in the warehouses. We are awash in metal that doesn't have an immediate buyer. And it's not just silver. Platinum inventories are 5 times higher than pre-election levels. Palladium's swollen too.
And this connects back to that negotiation window we started with. The tariffs are paused, but that metal is still sitting there.
Right. The flow to London eased the pressure a bit, but it doesn't solve the core problem.
Yeah.
There was a lot of supply, and as we just discussed with solar, demand is starting to look shaky.
So if the negotiations go south in 6 months,
Then you could see that inventory glut in London get permanently locked out of the U.S. market. For now, the signal is just too much supply, questionable demand.
Okay, that is a bearish, somewhat anxious case for silver. High price, shaky legs. Now, let's flip the script completely, because the JP Morgan report takes a totally different tone when it comes to gold.
Completely different. If silver is the volatile tech stock facing a regulatory crackdown, gold is the blue chip fortress. JP Morgan is explicitly bullish here.
And to be clear, this isn't because of solar panels or microchip?
No, gold does not care about copper substitution. Gold's drivers right now are almost entirely psychological and geopolitical. It's about fear, hedging, and sovereignty.
Okay, let's unpack the fear part. We always hear gold as a hedge. What specifically are these big players hedging against right now?
The report lists a greatest hits of economic anxiety, potential challenges to the Federal Reserve's independence, the escalation of geopolitical conflicts, and this is a big one, the looming risks around the U.S. deficit and potential government shutdowns.
The usual suspects, but maybe with higher stakes this time.
The stakes are higher because of who is buying. This isn't just retail investors buying gold coins for their safe at home. This is sovereign nations, the central banks.
I saw the numbers for Poland and Brazil in the notes. They seemed aggressive.
Aggressive is the right word. Look at Poland. They bought nearly 100 tons of gold in 2025 alone. They've pushed their gold reserves to about 30% of their total assets.
30%? That seems incredibly high for a modern Western economy. I thought they just held dollars and bonds.
It is high. And they aren't done. The central bank governor is asking for approval to buy another 150 tons.
Wow. Why? What is Poland seeing that makes them want to hold a third of their wealth in a metal?
It's a move for stability and independence. When you hold U.S. treasuries, you're reliant on the U.S. financial system. You're exposed to the dollar, to U.S. sanctions. When you hold physical gold, you hold an asset that is nobody else's liability. It's pure sovereignty.
In Brazil, I noticed they popped up in the report too.
Brazil is interesting because they've been out of the market for years. They restarted buying in September, first time since 2021, and they added over 40 tons in just 3 months.
So this isn't just an Eastern Europe thing, it's global.
Absolutely. Global net buying from central banks was over 40 tons a month in September, October, and November. That is a sustained, heavy bid under the market. It effectively puts a floor on the price.
So we have central banks buying to diversify. We have investors worried about the Fed. Gold is already expensive, though. How much higher do they think it can go?
JP Morgan thinks it has a long runway. Originally, they predicted gold would hit $5,000 an ounce by the fourth quarter of 2026.
5,000? We're trading well below that now. That's a massive jump.
It is. But given these new risks, the tariff wars, the deficit concerns, they think that target could be hit much sooner. And then they laid out a scenario that, well, it really caught my eye. We can call it the $6,000 question.
Oh, I love a good hypothetical. Walk us through the math on that. How do we get to $6,000?
It's all about asset allocation. There's a massive amount of foreign wealth held in U.S. assets, stocks, bonds, real estate. The report posits a what if. What if foreign holders of those U.S. assets decided to shift just a tiny fraction of that wealth into gold?
How tiny are we talking?
Just 0.5%? Half of 1%.
Sounds like a rounding error. That's a fee you pay your accountant.
In your personal checking account, maybe? In the world of global finance, 0.5% is an avalanche. If these foreign holders shifted just 0.5% of their allocation into gold, that would create approximately $17 billion in new demand.
$17 billion.
Per quarter.
$17 billion of buying pressure every 3 months. The physical market isn't that big.
Exactly. The gold market is deep, but it's not that deep. That single shift, just 0.5%, could push the price all the way to $6,000 an ounce.
That really puts the scale into perspective. We obsess over jewelry demand or coin sales, but the real needle movers are these massive institutional capital flows. A tiny tilt in the ship of global finance causes a tidal wave in the gold price.
That is the key takeaway. Gold isn't rising because people want more necklaces. It's rising because the tectonic plates of the global financial system are shifting slightly. And when they shift, money looks for the hardest asset it can find.
So, trying to synthesize this for our listener, we have two metals, often mentioned in the same breath, but they're heading in two completely different directions.
Right. Silver's facing that industrial reality check. It had a great price run, but the fundamentals are eroding. Solar manufacturers are designing it out of existence. ETFs are selling into the rally. And you have a mountain of inventory just sitting there.
And gold.
Gold is riding a wave of geopolitical anxiety. It doesn't have to worry about industrial substitution because it's not an industrial play, it's a monetary play. Central banks are accumulating it at record rates, and that potential for even a small shift in global assets could send it parabolic.
It really highlights the danger of treating precious metals as a single asset class. If you just bought a basket of gold and silver, you might be in for a rude awakening.
Absolutely. You have to look at the specific drivers. Silver is vulnerable to technology and manufacturing costs. Gold is vulnerable to, well, peace and stability, which frankly doesn't seem to be breaking out anytime soon.
That's a cynical but probably accurate take. Now, before we wrap up, I want to go back to that provocative thought on the negotiation window. We're in a ceasefire. What happens when that 180-day clock runs out?
That is the big question. If the negotiations succeed, maybe trade flows normalize and silver finds a balance. But if they fail, if the U.S. does impose strict tariffs, you could see that inventory in London become permanently locked out of the U.S. market.
It would create two separate markets, a U.S. price and a world price.
We're already seeing hints of that. But the bigger provocative thought for me concerns the central banks.
The whales we talked about, Poland, Brazil, China.
We know they're buying. But ask yourself this. When the entities that actually print the fiat currency, the people who control the money supply, are desperately trading that currency for hard metal, what do they see on the horizon that the average investor might be missing?
That is the chilling question. They aren't day traders. They are planning for the next decade. And their bet is squarely on gold.
It certainly suggests they expect a level of volatility in the current fiat system that goes way beyond just a normal recession.
Well, on that note, it sounds like the takeaway is keep a close eye on those solar panel spec sheets and maybe even closer watch on those central bank reserves reports. They might be the best crystal ball we have.
Couldn't agree more. Knowledge is power, especially when the market signals are this mixed.
Exactly. Thank you for helping us untangle this web today. And to you, the listener, thanks for diving deep with us. Whether you're holding silver, gold, or just holding your breath, we hope this gave you a clearer map of the landscape. We'll catch you on the next deep dive.